Right, hello and welcome. Been a few days since I've done a video, so I'm going to try and get one up now. This is Flowers Food. Now, I'm telling what I'm going to start with and saying is everything in this video I've already said no to. But what I'm going to try and do is smash through a few of the ones that I said no to because I want to be true to the intention of this channel, which was to try and vlog my journey of trying to become a successful investor. I don't know what I'm doing for the people that are watching this for the first time. I'm self-taught and I'm trying to see whether or not for the first time ever I can build my own portfolio and vlog my journey to see whether or not anybody can become a stock market genius, as Joel Greenblatts' book stated. So even though everything I've said no to here, is probably not fun watching, I guess, because you're not found anything just worth investing in. I just want to try and be true to my my whole channel's reason for being in the first place, which was to try and vlog my journey, so that if I become a successful investor, if anybody was to look at it in the future, there's sort of a blueprint out there of that it can be done if you're nobody and you want to succeed in it. It's not saying I'm going to succeed. 95% of people don't, but this is just a vlog journey, and then even if it doesn't succeed, people can look at it and then say, "Oh, well, this is what not to do," So yeah, so that's what we're going to do. I've got maybe 2 or 3. I'm going to try and smash through quickly. Reasons why I don't like them. We will just see how it goes. The first one off the bat is Flowers Foods. Bakery products in the United States, offers fresh breads, buns, rolls, snacks, tortillas. Nature's Own, we actually have in the UK. I buy some Nature's Own products. They're pretty sure they make Wonder Bread as well. But yeah, Nature's Own is one that I've definitely heard of. The rest, I'm not so well versed on the brands, that is. What I've also got as well is I've done a new tracker type notes, so everything now should be in a logical order every time we go through some stuff, because early on in my videos I jumped around quite a lot. Doing it this way, I've got pre-written in headings and then notes underneath about the business and all that sort of thing. So one of the first things we're going to talk about Flowers Foods is insider buying and insider ownership. Now we go on. Open Insider, there's not really been anything for a little while. There's been a couple sales now. This is quite a large sale, I have to say. A lot of people say you shouldn't be focusing on the sales because people can sell for any number of reasons, whereas they generally only buy for one reason, and that's because they think it is undervalued. You wouldn't be buying something if you didn't think you're going to make something out of it. So the sales, that is a large sale, 4.5 million, but we try to overlook that and focus only on the purchases, and the purchases were higher, considerably higher than prices now. You're almost talking, what, 40%, 40-50% higher than where we are right now. So I guess that's something. I mean, a bit of a small amount, really. It's that 300k total. It's not to be sniffed at, and it was all around about the same time, which is something as well. Yeah. Insider buying. Notes a minute, this one here. The other thing is that the percentage of inside ownership is quite high, 11.5%, which I like. I like inside ownership. I want the shareholders, to be aligned with the board members and all that sort of thing. The goal has to be aligned. If we bleed, they should bleed. You know what I mean? Yeah, wrong saying to use that, but you want to know that their interests are aligned with yours. The only thing about this, those 11.5%, is that it appears to be only 3 of what I count was 21 people. So yeah, that's quite good at 11.5%, but 3 out of 21, not great, but it is what it is. Let's have a look, blow up on here. See what coming up. That was foods. There's not really any large fund holding, in my opinion. 5%. So that nobody's really very big on it, I would say, and that's something I also don't like. The highest ownership is Vanguard, BlackRock, State Street, usual suspects. So that's nothing to be getting excited about. I don't think even the percent of portfolio, 5 to 6% is all right. It's not great, is it? When you were to look at like something like AMR, Alpha Metallurgical, which we did a video on before, the Monish Proprietor's got a significant portion in his portfolio in that, and that obviously shows that he's very confident in that decision. That's the sort of thing I like to see, is large positions, large insider positions, which we haven't really got here. Let's try that. So the second largest producer of market baked goods in the United States, headquartered in Georgia. Basically, they run branded products, which is, like I said, Nature's Own, Wonder Bread, or Wonder. I don't know if it's Wonder Bread. That's just from Talladega Nights, in it. Some of these other ones I haven't heard of. And then they've got private label stuff where they're obviously making stuff for other retailers. Branded products 65% of their revenue, private labels 35% of their revenue, and this is the breakdown of where they sell it. It's 41% in supermarkets, 33% mass market or mass merchandisers. So, saying like Wall Street, Sam's Club, Walmart, and Sam's Club, and then 26% is other. So, they've got quite a lot. Full service grocery retailers, Kroger's, Albertsons, Publix, and then pharmacy-led convenience retailers, sell snacks, baked goods, CVS, Walgreens, Rite Aid. So they're in a few places. Any significant future risks. So if you wonder where I get this from, a lot of it is from in ChatGPT, just to try and get all my data in one place. Generally, they put sources in, so it's quite easy to see where they're getting their data from on these links. But yeah, future risks, they say, in deterioration, national global economic conditions, reduced consumer demand, so that's a standard boilerplate thing. Increasing costs or shortage of raw materials, flour, sweeteners, another standard boilerplate risk. Apparently climate-related risks as well, so obviously that'd be to do with crops, extreme weather, not being able to, get your wheats and all that sort of thing. Again, standard boilerplate risks. So apparently the industry, apparently it is a mature industry. With bakeries have been about for thousands of years, I guess, haven't they? And large-scale bakeries have been a while as well. So it's a very mature industry, very competitive, subject to shifts in consumer preferences. People want to go for healthier eating, so flour is one that, failing to adapt to these changes, can negatively affect the business. So basically, here in Capitals, nothing here seems out of the ordinary. So the reason why we've had quite a large decline, look at this. When I see stuff like this, I think, oh, maybe there's opportunity, but obviously, like I've already told you, I'm going to say no to this one. We'll quickly smash through why. So apparently a large portion of the drop, large portion of the drop came from the fact that they cut guidance, signaled a slower growth than they expected. Net income dropped by 13%, despite raising full-year guidance more than peers. The company faced market disappointment, shortfalls in EBITDA and organic growth. Growth prospect looks abysmal, and the company keeps guiding lower. So, not great. The way things are going. Looks like their good times are potentially over. Now, let's get the balance sheet up, because I'm on latest balance sheet. Here we go. Just here. Let's drag it here so we can go together. So one of the things I didn't like about this is they've got quite a low cash position. 11 million for me is not great. Large receivables. When we bring up the amount of receivables, though, like that to me seems like a very large amount of receivables, but it's nothing out of the ordinary compared to their. I'm going to talk about flowers. Here we go. It doesn't seem to be anything particularly out of the ordinary compared to what they normally have. 400. So this is rolling 12 months every from whatever quarter we're in now. What quarter we're in? So that's Q2. So rolling 12 months starting on Q2, rolling 12 months starting on Q2, and so on all the way back. Look, 400, 400, 300, 300, 300, 300. So receivables, they're not very good at collecting them by the look of it, but it's nothing out of the ordinary for this business. So that's something. So when it comes to the inventory, so as we're looking at the quality of the current assets here, a lot of it's raw materials and finished goods and stuff like that. Well, it's reasonably logical to say that inventory is held very close to market value, because ChatGPT reckons that it only stays around for 2 to 3 weeks, because obviously food goods go out of date. So it's on their inventory's on their books for so short a period of time. It's very unlikely that it's the value of it's gone too far away from the actual market value of it. Normally, a lot of inventory would be very obviously like marked down if it's held for too long, that sort of thing, retailers and all that. But GPT is of the opinion that because they only hold 2 to 3 weeks of production, inventory value is basically market value and doesn't really need to be adjusted. So it's not bad. Current assets are 740 million, 741 million, compared to liabilities of 589. So, the quality of the current assets seem to be all right. There's large operating leases with this company. 73 million TTM, and then 255 million total. If you were to take the operating leases out of the total debt, then it would actually add another $1.50 onto book value. I am someone, much like Keith Gill and Michael Burry and all that, that's not too keen on operating leases being classed as debt, because they're not. It is debt, all right, you do owe it, but you can also, like, if there's ways to get out of it, like subleasing the store. So yes, you're still on the hook for the lease, but you can actually put another business in it, and then they pay you, and you pay, the people you're leasing from, and that sort of thing. So it's a different kind of debt. It's not like interest-bearing debt, which can get you in a lot of trouble. So yeah, not so keen on that. But like I said, that would put another $1.50 onto the book value, which is, I suppose around about close to the current price of what, 11.93. This data at least. So something I don't like at all. Goodwill increases, 50% increase year on year. Tangible assets of 4.3 billion has 50% goodwill and intangible assets. So, sorry, total assets, not tangible assets. So if we go on, we'll see it here. This is white sheets data all drawn into one area, as opposed to sort of picking through it on here. It does line up the same, but total assets 4.3 billion here. We got goodwill here, just over $1 billion, and all the other intangible assets here, are just over $1 billion as well. Half of your total assets are non-tangible assets, which obviously is a problem, I believe, when you've got large amounts of debt. I like to have tangible assets. I don't particularly like negative book value. I'm the wrong one again. I don't particularly like negative book value, which is what we've currently got here. there was a, almost 50% increase in goodwill year on year, and the same with intangible assets. Not particularly something I like to see, especially when it negatively affects tangible book value. You need those actual physical tangible assets to sell. Should be not to sell, like you don't need to sell them, but it's downside protection to have them there should debt become a problem in the future for a business. So it was a Simple Mills acquisition, I believe, mainly financed by debt issuance of debt, caused total debt to almost double. Not cool. So total debt down here, it was 1.4 billion. Now it's just over 2 billion. So it's not, I guess it's not quite almost doubling, but it's still a considerable difference. But ChatGPT reckons that the replacement value of their 44 bakeries is in the 3 to 5 billion range, which is, somewhere in the middle of what their enterprise value is at the moment. So it's not to be sniffed at. There is value there that could cover this debt. EV is close to 5 billion, with long-term debt at 2 billion. We've already spoke about that. Interest expenses increased circa 30% in the last 3 years. Now stands at 55.5 million, but free cash flow hasn't been below 105 million in the last 15 years. So that's pretty good. We can see that down here. So interest expense was 37, now it's up 55, and on average free cash flow, over the last 10 years is around 226 million a year. So their interest coverage is very good. It's not a problem there. That's what bright green on my thing. 6 times 4, 3, 4, 7, 8. So their interest coverage is very good. So they're, effectively their debt is not too huge a problem. Return on capital for EBIT 21%, and return on capital for simple free cash flows 22%. So that's reasonably good. Return on capital. Not too unimpressed with that. So the balance sheet isn't great with goodwill and intangible assets, but the replacement cost is at least reassuring for 3 to 5 billion. When you've got 2 billion in total debt, yes, if you were to sell them, you'd lose a significant portion of your revenues, but there is downside protection to Flowers Foods. Income statement, slight decline in revenues, but cost of goods sales declined almost the same, showing costs haven't materially increased. Gross margins been around 48% for the last 7 years and barely changed, so that's good to see. Gross margin up here, 48%, literally the whole time we've been on here, 48%, and the costs are very, very similar as well. They've only crept up 2% on average SG&A margin over the last few years, so that that's pretty good as well. It's very stable, I would say. Net cash impacted by 800 million acquisition of Simple Meals, caused goodwill to increase by 330 million. Statement shows an increase of CFO. Sorry, I'm the wrong one there. I'm a bit too far down. Average CFO margins 8%, currently 7.9. So that's a 7-year average is 8%. So you bang on the average really. Operating income margin both slowly declined over the last 5 years, which we can see here. Was mid 6s, now it's down into mid 5. Net income was 4, now it's just just below that. So there is a slowing down in the earnings of this business. But good margin control long term. I don't think you can really argue with that. There is pretty good. And at the current price of $11.93, they pay. They pay dividend. Got here. So 24 cents or 20. Around about $1. Around about $1.24. So what have we got there? So 8% dividend yield with the way things currently are, and obviously the free cash flow is reasonable. So it's not it's not bad, is it? So at the current price, dividend yield was 7.5%. So the price has dropped since I've actually wrote this. I wrote this a few days ago. So obviously the dividend yield's gone up. What I don't like, I generally don't like this ever large stock-based compensation into the operating earnings, which, you know, I don't like that. I do believe that stock-based compensation is an expense, much like Warren Buffett. So I don't particularly like stock-based compensation. When I do my simple free cash flow metric, I actually take away stock-based compensation. I don't want it in the overall figures because I believe it's an expense. So what have we got? Increase in CFO margin by 98%, but payables of 54 million. Deferred income taxes added another 28 million. There's a 52 million swing in collecting receivables compared to Q2 2024. Let's bring that up and show you flows. So accounts receivable, they're much better collecting than what they were last year. Inventories, obviously it's had a swing going the wrong way. The accounts payable's got a huge swing, so they paid, 6 months ending 2024. There's a huge swing in payables that are actually on the books, so obviously that's positive for the look of the cash flows. Actually, that's that's a bit of what do you call them? This cash flow shenanigans, isn't it? The book, it's a very good book actually to read. So there's a bit of tomfoolery going on in the cash flow from operations there. Really, net cash is impacted by 800 million acquisition of Simple Mills, caused goodwill to increase by 330 million. So they also issued, where is it down here? Proceeds from debt borrowings. So they borrowed another 866 million in debt, likely to purchase Simple Mills. So that almost doubled the total debt. The cash flow margin is pretty stable. Bring that up on to get the right one up again. Yeah, so it is pretty stable. A couple of down years there, sort of got a bit better here. But yeah, simple free cash flow margin is quite stable, so we quite like that. So the average free is 4.78%, the long-term average is 5%. Free cash flow yield against the enterprise value is 7%, so that's higher than the US Treasury. So that's what I'm always looking for. I want 3% above the US Treasury, which I believe is what Joel Greenblatt and Michael Burry, when I've analysed some of his trades, tend to look for. And it's certainly higher when you use market cap instead. I use enterprise value because I want to know when I'm doing my comparisons, I want to know like how the debt loading affects the comparisons and things like that. So I've got yields and multiples against market caps, but generally I'm almost always looking at the enterprise value because obviously the debt is a very big real thing that you need to take into account. So free cash flow multiple to EV has got a historical average of 19 and a 13 to market cap. So here we go. So along here, we've got some very high years though here, like 27 times earnings, 33 times earnings. So that's really, goosing it a bit. But that is your average, the average multiples. EBIT multiple to EV is only just below the long-term 16x average, currently at 14.5. Peer analysis will determine this, but the assumption is it's fallen simply because it has spent a long time ridiculously overvalued. This is my opinion. It's just been way overvalued. Dividend has always been around about $1 a share. Current dividend yield 7.5% or so, which is pretty good. I've only done one peer analysis actually, because it's very difficult actually to find bakers that are, or businesses that are very identical. I know it's a food processing business, so you could use other ones, like is it BGS or BNGS Foods or something like B&G Foods? I can't remember, something like that. You could use stuff like that, but I tried to use one that is almost identical in its business model for my peer analysis, which is why I've only got one on here, which is TWNK. So it's Flowers, you know, considerably higher debt loading. Debt to equity is higher. Interest coverage is good though. We like that. And the simple free cash flow yields are actually higher, which we like. The operating cash flow yield is considerably lower. Net income is lower. Operating margin is lower, but gross margin is lower as well. The multiples here are huge though on TWNK compared to what they are on Flowers Foods. Did got it here. Right here. So EV to free cash flow, packaged foods and food processing, you look in 12 to 25x range. And yeah, I would never go on the high end, not when I'm doing my multiple analysis. I'd never use the high end. I think that's ridiculous. You need to be conservative. EV to EBIT is roughly 11 to 16 x according to ChatGPT. So this one here. You know, I would say that it's probably in the region of close to, I would say it's overvalued, but you know, compared to the potential high end of things, I guess it's particularly not. But they've given guidance of 5.2 to 5.3 billion revenues, which is 2.7% more than the current year, expecting capex to be around 135 to 145 million. So in my forward analysis, what would you call it, like present value analysis of forecasting, that's what I'm trying to come up with. I've used this is changed from something else. What did I use? 5 billion in revenues. Let's just change this. 5 billion in revenues. And what else did I do? I'm happy to use 80% of the margins as they're pretty consistent historically. So what I do is I use simple free cash flow margin and then percentage of it, depending on how consistent they are, is the higher percentage that I will use for my forecasting. But 80% is what I'm happy to use. That's what I'm so we need to change that to 0.8. Oh, wrong button. Microphone 0.8. So 191 million future simple free cash flow. We're using the free cash flow margin against 5 billion in revenues, which would be a 13x multiple, which is probably now, you know, where if we're on the conservative end of 12 to 15, you're probably looking around about fairly valued now. Let's say around 200 million mark would be a forward multiple of 13 to 14. So the average market multiple is 13. So you're fairly valued to slightly overvalued now. 3.5 billion replacement cost, free cash flows, the multiples that they're at. Not really interested. Only positive is the dividend yield is very good. 7 to 8% or whatever it was. So yeah, that's Flowers Foods. That was my thought process when I was doing it. Not, it's not great, especially when you look at the price decline. Looks bloody awful, doesn't it? But when you down here, look, this one here, if you just read the light blue part of it when you're going along, you've been on the higher end really throughout of 22 times price free cash flow, 40 times up here, look at 40 times, 100 times free cash flow. And then people are wondering why it collapsed. It's just been overvalued, like massively overvalued in my opinion. You're saying, if we're going to say conservatively 13 times free cash flow, if you're getting up here, 90, 100 times free cash flow, for me as a value investor, wouldn't touch that with a ball at all. And now we're actually into an area where I believe it's around about fairly valued again. I'm sure there's a lot of people that disagree with me, but this here, this whole portion here, to me, fucking ridiculous. If I'm honest, that people are willing to pay 100 times cash flow for a bakery. I mean, I wouldn't pay 100 times cash flows for anything. Not even technology companies. It's not me. I wouldn't do it. Not my style of investing. But for a bakery, 100 times free cash flow, you're having a laugh. And so no wonder, in my opinion, you've had a 60% decline in the stock price. For me, in order to be interested, it needs to come down more. That's not saying that I believe it will come down more, because, like I said, my valuation now is that you're in a slightly overvalued to fairly valued range of price now. But yeah, it's not one for me. I'm not interested in it, just because it's just, to me, it's just not cheap enough. It's still not cheap enough. Yes, the dividend is pretty good. I believe the dividend's very consistent. Can we see that? So divs share, so the dividend's very consistent, and I know some people are willing to pay up to 20 times dividends, which obviously would be considerably higher than where it is now. They have the cash flows to support the dividends because their interest expense is not particularly high. Yeah, from a cash flow multiple basis, it's too expensive. The replacement cost value is reasonably good, but I don't like that we now got a negative tangible book. Do I believe that it's going to be a problem for them? No, but it's just not cheap enough for me. Just not cheap for me, and that's Flowers Foods. What else can we do? Let's have a look. Have we got anything else up ready to go? CLVT. Have I got that ready to go? What was this one? CRT. Okay, so CLVT. Let's get this up. Sorry, I'm just going to bear with me. Yeah. A lot of copy and pasting, unfortunately. I haven't got the fancy spreadsheet that Roaring Kitty's got, where he just writes in a ticker and it does it all for him. CLV, Clarivate. I haven't got the internet speed to do it. I can do it. You can make Y sheets do that. I haven't got the speed where I am to do that. I live in rural England. You ain't getting internet speed good enough to do that without materially impacting your. I think I did build a spreadsheet that tried to do it, and it took ages, like minutes. We're talking like 5, 6, 7, 8 minutes to draw the data in. But I found that just by copying and pasting it, it's miles faster. Yeah. Comp in as well. Need to put the comp on here, I expect. Yeah. Right. There are a couple of things about this business that I do like. Let's drag this one back up here again so you can see it. Notes, CLVT, Clarivate. So, global information service and analytics company. It provides data insights, workflow solutions. So, tools and platforms for research institutions, libraries, provides analytics services, patents and trademark research, headquartered in London, UK. So in a world where research, intellectual property rights and life sciences development are increasingly data-driven, Clarivate sits at an important nexus enabling universities, governments, corporations, law firms, pharmaceutical companies to access and make sense of large data sets and analytics. The transition towards recurring revenue models help there. Okay, more predictable. Really understand this business, which is one of the reasons why I'm not interested in it. But ChatGPT is very good for that. Actually, all this information came from ChatGPT, but you can literally say, like, make it dumber for me, make it dumber for me so I can understand it, and it will do it. But we'll start off where we did before. Insider purchases. Said something love to see is insider purchases. See if this will work. So CLVT there, got a red mark beside it. This. Oof, what a drop. What a drop. They're purchasing around about beyond, I suppose, 374 is considerable purchase. These are large purchases, mind. You know, 1,000,000, 200,000, 100,000, 254,000, 600,000. So, you know, that's good ultimately. I mean, these are a long time ago now, you know, 6 months ago. Yeah, that's good. That's a good amount of insider purchases, really. So insiders own over 23% of stock, seems very good, but mainly it's 3 people, one owning just under 17%, another 3.5%, and another 2.3%. I don't know where you can get that data. The here, documents on the DEF 14A search beneficial. Here we go, beneficial ownership. So 23, 24, you know, 23% is really good, but again, same as Flowers Food, it's actually just a small amount of them. But then that's still this guy here. You cannot say that this guy here is not aligned with you when he, you know, 17% of the shares he owns, he is invested in this company. So, yeah, all right, it's only 3 of them, but when you've got someone this invested, you can't say that he's not aligned with your interests, is my opinion on that. So, Well Wisdom shows a number of funds with good holdings. Get it up here. So I want to see insider buy-in, and I want to see other hedge funds that are interested in this stock. So 50% of portfolio, 14% of portfolio, 8%. So, you know, there's people that are interested in this. Let's put it that way. You know, it's a reasonable conviction, I would say, amongst funds, even if I haven't heard of them. So I did look into them. I haven't heard of any of these funds. There's people with reasonable conviction, which is obviously something that you'd like to see. But share count has almost doubled since 2019. There you go, 300 million up to 600 million. They've bought back a considerable amount as well, so they're trying to get it back down. But this I don't like to see. I don't like seeing dilution. Not something I'm interested in. Dilution is not shareholder friendly, in my opinion. Revenues. Here we go. Future risks. Hang on. High profile tools, broad global footprint. Revenue growth, organic revenue growth has been modest. The business is exposed to changes. So R&D spending, it has to be high. Oh, sorry, it's exposed to changes in R&D spending, macroeconomic conditions. This transition in its business model as well, from a transactional to subscription-based model. That can take time and put pressure on short-term financials. I didn't go too deep into this one, to be honest, because I didn't really like it from the off-book values decline. Don't like that. 21, 17 down to 734. Great. So let's have a look here. Balance sheet. Total assets of 11 billion, right? And goodwill and intangibles is almost 10. Not for me. Look at the tangible book value. Awful tangible book value. What's the total debt? 4.5 billion total debt. So that's come down though. Given their due, it was 5 billion. Yeah, it's come down. They're eating into it. If anything goes wrong, 10 billion of it is intangible. You know, there's no asset. But this is one of the reasons why I think I went a bit short on this one. I don't like that. I want physical assets to be able to be sold should the debt become a problem. And look at this, return on capitals are awful as well. Yeah, 4.5 billion in long-term debt. Current assets are good quality. Let's get them up. Let's get the actual balance sheet. All right. New interactive data, so that's just come out, is it? But if I don't know actually if my data has this in here, but so 300 million in cash, 800 million in accounts receivable, so that's the lion's share of it. I would say they're good quality current assets. Total liabilities is very high as well, current portion of deferred revenues. So that's obviously stuff that they have already taken money for, but they haven't supplied the business. So yeah, I don't know where I'm going with that, but I'm just that's what that is, I believe anyway. Yeah, 11.4 billion total assets, 9.9 billion in goodwill. Not cool. Current assets good quality, which we've just shown. 4.5 billion in long-term debt here. Acquisition of Decision Resources Group. The purchase was about 950 million, including 900 million cash and 50 million in shares. And then they acquired CPA Global in October 2020. So 2 acquisitions in a year. Total consideration was approximately 8.5 billion net of cash, composed of share issuances, which is why the share count went up excessively, plus cash largely to repay CPA Global's debt. They paid off around $1 billion in 4 years. Total debt went from 5.6 down to 4.6. Like I said, we pointed that out, so that's reasonable. They're eating into it. Not great, but they've eaten into it. Significant debt maturity. So this is where another thing that I look at is the maturity schedule. You can find that in the notes. Is it on this one, or do I go into the debt? Here we go. So debt maturities, the value of the debt maturities. You can find that in the notes on the used 10Ks. So 700 million due next year. Next significant amount is 900 million in 2019, 900 million. You have a 2.2 billion matures past 2031, so it's not that bad a maturity schedule. And they've also got 700 million revolver, which matures in 2019. Goodwill has dropped significantly. Let's have a look. It's been a little while since I've looked at this one. Yeah, here we go. Look at this. 6 billion in goodwill after the acquisition, and it's been written down to 1.5 billion. To me, poor acquisition. If you're paying over something and then it gets written down that much that fast, that was not a good acquisition. I always see goodwill as a future write down, but that was awful. Not a good acquisition. Revenues have fallen almost 4% year over year. 3%. 3%, yeah. Gross margin has fallen slightly over the years, 66% down to 63.5%. I wouldn't say that's bad. SG&A margin has fallen 40%, so cost control has improved. So I've fallen from 40% down to 29%, so cost control is significantly improved. Right, you can't knock that. Gross margin has declined slightly, but the cost control has declined a much larger portion, so that's good. Gross margins decline. You want the costs to decline at least in line with it, really, to keep things as close to as they are as can be. Operating margin, though, has been negative 3 out of the 6 years, and it's currently negative now. Net income margin has never been positive, and it's currently negative 4.5%. Look at that. Never had a positive net income margin. That's not the end of the world, though, right? Because I go off simple free cash flow, but it's still not great to see. D&A is killing earnings, but obviously it's added back in simple free cash flow. So this is what we'll see. Depreciation, amortization. Look at this, 700, 600 every year. So without that, your net incomes would be positive, but obviously when it comes down to simple free cash flow, it's added back in. So that's what I said. It's not the be all and the end all. Get down to the cash flow statement, depreciation, amortization is added back in because obviously it's not a cost that's happened in a year. It's a cost previously. That money's not being spent this year. It's been spent before. So it doesn't look great on net income margin, but the simple free cash flow margin significantly improves things. It is basically the DNA that is killing the earnings. It's been very high since the acquisition in 2020, but stock comp as well, very high. That 56 million, 60 million, 124 million there. Like, I don't like that. Don't like that. Simple free cash flow barely covers interest expense. Interest expense has dropped marginally because they've paid down a little bit of the debt. So down here, simple free cash flow 278 million, interest expense 269 million. Not great at all for me. Interest coverage ratio just over 1. Historically, it's always been that way, but for me, there's not enough protection there on that debt. If revenues decline significantly, not great. You could be in trouble very quickly. And because you've got a negative tangible book, you could also be in more trouble with that because you've got no way of selling stuff in order to pay off that debt if it becomes a problem. Your interest expense is far too high compared to simple free cash flow. For me, I forecasted 2.2 billion. Probably come from chat. I haven't wrote where it's come from actually, but it's probably come from ChatGPT. I always ask whether or not they've put out any future forecasts or anything. So that would be another reasonable drop in revenues, and that will put a lot of pressure on the interest expense. Let's have a look. Let's just do it. What did I say? I've already forgotten what I said. I forecast 2.2 billion. Up here. So on 80% of the margin, simple free cash flow margin, which you've had, you're higher, 12% currently, 11%, 12%. So you've hovered around the 12% range for 3 years. Or that was historically a lot lower. Am I comfortable using 80% of the 3-year average margin? Not overly, but I'm not interested in this stock anyway. It would be a 9 times multiple then. What's the peers? I got a peer up here, haven't I? Peers trading at like 17 to market cap, 19 to EV. So obviously we're already at 23 to EV. Clarivate, which is above that. But currently at a market cap, I don't do market cap. I do EV every single time. But 9 times. The problem you got here, right, is that if I'm forecasting this conservatively, it is always conservative with me. 228 million interest expense of 269. You're in trouble. You're eating into a cash position that does exist, but you cannot sustain that for very long. There's just too much pressure on this business for me, and that is why I am not interested. Revs expected to drop to 2.28, and that's their forecast. So I've used 2.2, see if they can cover interest expense. Forecast lower simple free cash flow margin. Using the 10.8 instead of the average of 13.6 would give free cash flow of 239, nowhere near enough to cover the interest expense. Even with debt pay down in 2026 and EV remaining constant, market cap will only rise by 30 cents. ChatGPT states peer average EV to EBITDA is 13.6. EV to simple free cash flow average is 30, seems very high to me. RELX is trading at 17 times X to market cap, so maybe 13 would be 525 a share, so that's a 40% increase, but EV multiple for RELX is 19 and CVLT is 23. Currently a no. Too much pressure. The interest expense is too high compared to simple free cash flow. They could be in trouble next year if their margins don't improve significantly, and they're forecasting another drop in revenues. it's a value trap, this sort of thing for me. It looks good. Here, you think, oh, there could be something here. Look at how it was trading. But when you have got no tangible assets to help you cover that debt, it's a value trap to me. It's a value trap that could very well be in a lot of financial trouble, just the way things are. So CLVT, I've been saying CVLT, CLVT, Clarivate, another no. Not for me. What is the next one that we had? XIFR. Is it worth going into this one? Yeah, because this one was reasonably interesting, even though it's quite short. We'll probably finish the video on that one because it will be just over an hour. Come to that. So let's put this in. I haven't done any comps on this one. XIFR. Drag it in. Let's go. FR. It's reasonably interesting, this one, in that it's got a huge asset value to it, which is way above current price. I've not got a lot of notes on it. I can't remember this. I remember what this business is, but the fact that I've not wrote a lot of notes on it to me suggests that really not enamored with it. So let's just see what I did right. Right. Any insider buy-in? Oh, I got a funny feeling it was a no. So no. Here we go. Look at this. Drop. Highs down to here. 88% drop. Massive. So what is XIFR for those of you who don't know? No insider purchases in the 2 years, no institutional ownership. Most institutional ownership of any size are put. So let's get that up, show you that. I'm going to do it all in a similar line. .3%. No one's interested in this. Like, nobody's got a big play in it. This is sorted from the highest percent portfolio. 1.3%. Nothing. Who owns the most? Nobody that I've ever heard of. Let's put it that way. But nobody's interested in it. Of any conviction, nobody is interested in XIFR, including the insiders, because no insiders have bought it. So basically, it acquires, owns, and operates long-term contracted clean energy infrastructure, wind projects, solar, battery storage, some natural gas pipeline assets. So it's a subsidiary of Next Era Energy, formerly known under a different name and recently rebranded as XPLR. So assets are contracted, meaning they have power purchase agreements or capacity agreements in place, which helps to stabilize cash flows and reduce exposure to pure spot market price volatility. They've also suspended the dividend in 2024. I haven't really done a breakdown of the revenues, but they are semi-consistent. So future risks, debt financing. The company is raising large amounts of debt. This exposes it to interest rate risk, refinancing risks, and credit risks. Because of their many assets depending on tax credits, regulatory frameworks, changes in legislation permitting can adversely affect the business. Assets such as wind turbines, solar panel, battery storage, performance, availability risk. Also pipeline assets such as transmission, interconnection dependencies. Asset concentration. While being concentrated helps, performance still depends on meeting contractual obligations, so minimum availability. That's like electricity and all that. If they're contracted to produce a certain amount of electricity, they have to try and meet those targets. Also, many assets may be geographically concentrated and thus vulnerable to weather and climate risks. So that means like a solar farm, or effectively they could have a solar farm that's very large all in one place. If there's bad weather in that area and it knocks that offline, that's going to significantly impact them. But book value way above the current price, 986, 119, and tangible book value is way above the current price at 101. Long-term debt is 6.6 billion, which is very significant, with short-term debt of $1 billion. Cash is currently 880 million, so it's below the current maturities. In 2026, it's 2.8 billion maturing. 2027, 2 billion maturing. 16.2 billion of the assets are power generation assets and likely make up almost all of the revenues. The ability to cover the debt is high should these assets need to be sold, but that will have a material impact on revenues. And that's also very hard to determine how much of an impact it would have. Well, yeah, balance sheet is, it's not too bad. Goodwill and intangible assets are only 1.7 billion of the 19 billion. So I suppose from a standard value investors play, when value is that much higher than current price, that's, it's not a bad thing, is it? Total liability is 9 billion. So this is why book value is high, tangible book value is high. Short-term debt of 1 billion and then 5.6 billion long-term debt. So we wrote on this. Like I said, I didn't write a lot, so I wasn't enamored. Revenue's been reasonably consistent since COVID. Here, like I already pointed out that the revenues ain't too bad. They're reasonably consistent. Large decline over time of gross margin. So 66% down to just under 50. Not great, don't like that. Particularly, I'm sure there's reasons for it, but not something I like to see. So this is the reason now why I don't like this, right? So the free cash flow appears quite good. Here we go, 600 million this year. It's all over the place, mine. 300 million, 260 million, 400 million, significant losses, 149 million, 600 million. It's all over the place, but this is why I immediately said no to this. So free cash flow appears to look quite good, but they have an agreement with Near, who is that next era people, their parent effectively, who provide credit support to XPLR. So in return, XPLR pay credit support fees to Near quarterly. Near also has the ability to sweep cash from XPLR before it can distribute it to shareholders. So effectively, if they decide that they want to take some free cash flow out or some money out of XIFR, then they can do it, and there's nothing that can be done about that because termination of this agreement requires consent from Near. So if XIFR wanted to say no, you're not having the money, they actually need the people who have the right to take the money to say, oh, okay, we're not going to do it. And I said this agreement can effectively wipe out all free cash flow from XPLR. So for me, the fact that the company potentially cannot keep its own earnings and has no say in that because it's down to the parent, that's a big no-no for me. That was a red flag straight away. Not great. So at first glance, this company looks reasonable. There's a lot of debt, but more than enough assets to cover it. Tangible book value is 10 times higher than the current price. But a credit support agreement with the parent can give them no control over their finances. Don't like this, so I stop there. Not proceeded with a net present value. Asset-based play, there's significant upside here, but the cash flows are contractually uncertain. Yeah, so that was it. That was XIFR. Unfortunately, like I said, from a book value perspective, there's definitely room there. From a cash flow perspective, the fact that they've got no say over whether or not it gets taken from them, not cool. Not interested in something like that. It's a bit of a red flag, unfortunately. But then I suppose on the flip side, as the parent, it is in your interest that the business keeps going, even though you can effectively steal money from it. I could have that wrong, right? I could have that understanding wrong, and if I have got that understanding wrong, please put it in the comments. I'm on a learning journey, so it'd be very interesting for me to find that out. But to me, that is how it comes across, how it sounds, so they can just take cash if they want to. Obviously, they are the parent of this company, so it is in their interest for this company to survive. So, there is that side of things to it, and the assets being considerably higher in value, 9.5 billion in tangible book value with a total debt of whatever it was, 6 billion or whatever. they got the assets there to cover it, you know, and it is in the parents' interest for this company to keep going. I just didn't like the idea that they potentially couldn't keep their cash flows, and there's nothing they can do about it. The termination of this agreement requires consent from the parent. So that was it, end of that for me, unfortunately. If you are interested in asset-based plays, then there's something here, I would imagine. You have the potential, and from my understanding, which I said, which could be wrong, for this company to never earn anything if the parent doesn't want it to. So that was me out. So we've gone through 3. There's one more that I've got here that we could go through. Let's save it for another video because this one's been going for a little while now. And then we'd be up to date actually on that one, but I'll save that for another video. So yeah, unfortunately, like I said at the beginning, 3 businesses, 3 no's, some interesting things in all of them. You've effectively watched this, if you have got this far, for me to tell you that I'm not interested in any of them, which I did pre-warn you about at the beginning. But for me, it's just about being true to the purpose of what this YouTube channel was built on, you know, showing my journey, seeing what I see, hopefully other people eventually networking with me and telling me that I'm wrong, because that's what I really want to hear, effectively, that I'm wrong. I want to be able to critically think my approach so I can better my approach. That is where we are at. And like I said, next time we'll get on to CRTO, Critio. Now we're going to leave this video here. Thank you very much for watching. And I will see you on the next one. All right. Please like and subscribe if you like this. I would like to try and grow this channel, purely mainly for networking purposes for me. But yeah, please like and subscribe. Sorry that it's all no's. I know it's not exciting, but this is my journey and I'm showing it, and this is what I have found. Thank you very much. See you on the next one. Goodbye.